that there was an inefficiency of sellers. So the reason why he's bringing your attention to this specific bullish candle, this huge one, is because it ran and didn't allow these wicks to fill the gap in between. So it created an inefficiency of sellers. That's what he calls it. Like a BISI, buy side inefficiency, or buy side imbalance, sell side inefficiency. So that means that just like these ones up here, it's also a fair value gap. But this is a discount one, and that's why he actually referenced it for the trade. But basically, sellers have to come in and fill it. So just to give you guys another example, let's go into our charts, and I'll show you like the current fair value gaps. Go to an empty chart. Okay. Right, another big bullish candle. This is a daily time frame on Euro USD. But basically, you just take it from the bottom of the wick whenever there's an inefficiency to the bottom of the wick here, top of the wick, bottom of the wick. You extend it out, and what do you see? What can you see already? Like, this was just a random example. I haven't even been looking at Euro USD. But you can see that price references the fair value gaps. It ran to the midpoint, and now it's pulling back with a huge pullback already. Look at this. If you were paying attention to this midpoint on Euro USD, you could have already caught your pips for the day. Like just targeting maybe this high, or just targeting it leaving the daily fair value gap. That's an example of a fair value gap right there for you. Top of the wicks, like it's the 3 candle range. Top of the bottom candle, bottom of the top candle. And you can see that's exactly the same as he outlined here.
How old I am. Every time we would create a big candle like this, I would call it a caffeine bar. And it's just a lot of energy. And you hear me sometimes say, I want to see an energetic move. Every time I say it, my mind goes back to the good old days on Merck. But your eye should be gravitating to these types of movements. This is a buy side imbalance, sell side inefficiency. Its category for a PD array is fair value gap. But its distinction is a buy side imbalance, sell side inefficiency. BISI. B-I-S-I. Okay? So don't bother Googling it, because this is all my language. This is my vocabulary. I created this so that way you can differentiate what it is I'm referring to. And throughout the year, you'll know exactly what this is. Okay? By this time next year, you're going to be a pro at it. So you can see how we went down into that area here, dipped into it, and then turned around and attacked these relative equal highs. Now, before I drop down into the 1 minute chart, I want to kind of take you through this thought process. Right about in here, I tweeted and said, note 3814, because we could have easily spiked back down through here, cleaned this area up, ran the stops on anyone that was long with stop losses below that old 15-minute low. Let me bring it back here so you can see. So here's old lows here, and there's one more segment of price action right there. That's where those, I've been looking for a run to take these out, but it didn't give me that. So go through my tweets on Friday. You'll see me refer again as it's dropping down. Pay attention to 3814. But then we get into this area here, which I was watching, but I want to see proof. Okay? I don't want to just go in there and co-sign something on Twitter and not have any idea what it is I'm looking for. I want to see proof as to what it would likely do. If it's not going to go to 3814, that's fine. There's no trade there. I'm not selling short. I want to see if it can get to 3814. But if it cannot and it rejects this buy side imbalance, sell side inefficiency, what does that mean to reject? Well, it's not getting through it. So in other words, in the easiest language I could provide for you in regards to that, the lowest portion of that range between this candle's low and this candle's high, anytime you have a big one single candle and it's separated with the candle's high before it here and a candle after its low here, and it's just that range that's shaded in blue, there's only one pass, one candle, okay? That is significant when price is coming back down into it. But when there's high impact news drivers like, well, non-farm payroll or FOMC, it can overshoot these areas. Okay, so when I'm looking at price action, if I don't have a high impact news driver like FOMC or non-farm payroll, which I wouldn't be trading on non-farm payroll anyway, despite what you're going to see later on. On a regular day, like a medium impact or high impact news driver that's not FOMC, in other words, it's an interest rate announcement based report that's coming out, or just non-farm payroll. If I'm just studying price, I may be looking at non-farm payroll a couple times throughout this year with you all, just to reinforce the idea of what it is I try to avoid doing on non-farm payroll. So that way, you want to see me lose, you want to see me get it wrong, I'm going to stand in front of you live on a non-farm payroll and do the whole business right in front of you. And you'll see why I don't want to touch that day, because the elements of precision are likely to be outside my grasp.
Okay, just to pause there for you guys, and so you don't get confused, let me write down the 3 major news that you should actually pay attention to. So there's FOMC, there is NFP, the one that he's talking about right now, and then there's CPI. These are the 3 major news that you'll see an insane move for. Like, there's a bunch of other red folder news. Here, let me get rid of JPY. There you go. So there's always a bunch of other news. There's PMI. We have these unemployment claims. Here's CPI, by the way, which is this week, right? Yeah. So we have CPI this week. Strong news. But these news, it's like strong. It'll give you a move, but it's not going to be like these 3. These major 3, you want to like either stay out of the market or wait for like after them to trade. Because you'll see that it will like likely consolidate the days before and then like run on those liquidity, like I just showed you guys. It'll consolidate, and during the news, it runs on the liquidity. So just be careful of these. Learn from these news. Typically, news will reference like inefficiencies perfectly. I've seen news that like fills a daily fair value gap to the tick, and then turns around and runs higher. So it's actually insanely precise, except you can't predict it beforehand. And you don't know whether it's going to run up first or down first. That's why you stay out and you just observe it. Trading after is way more precise because there's always 2 targets, right? There's going to be a sell side inefficiency down here. There's going to be one up here. Okay? So what you do is you wait for news to take out one of them. News ends and you can finally trade. Some prop firms have like a 4-minute news restriction. You wait for that news to hit one side, and you see that it starts moving up. The only other inefficiency is up here, or maybe there's another one down here, right? But if it like disrespects a fair value gap up here now it gave you confirmation that it wants to move higher. Then you get in from that fair value gap, IFEG, and you target the only other inefficiency above. That's all you have to do. You can trade after and make more money than you'll ever need. You don't need to trade the actual news. And then what he's referencing here, this low. So if we saw a candle that actually closed below the low, it's disrespected. So this is a fair value gap, right? Buy side imbalance, sell side inefficiency. But what happens when a candle closes below it? Let's see if I can find an example here. One that has already been traded through. I'm gonna go to gold. I guess I'll just use the most recent example on gold. Here, 1 hour time frame. So if I clean up the chart here, let me get rid of this stuff. Okay, what do we have? I'm not gonna mark out these bullish ones, right? While they exist, there's also disrespected ones that you want to pay attention to. So what I do, see this bearish one over here. This is a bearish FVG. You can see that price referenced it as a bearish fair value gap. Basically, this is a bearish fair value gap. But once candle closes above it, you can reference it as a bullish one to go higher. So bearish one turns into a bullish one. That's called inversion fair value gap, IFVG. It's one of the strongest models because it's confirming your bullish narrative. So when it closes above it, so on the 30-minute here, we have another one right here, 30-minute time frame. It closed above it. I was anticipating buys from it already just because of the extreme bullish narrative for the month. But it didn't give it to me because I didn't see the higher time frame, and higher time frame always rules. So you can see this is what happens when a candle closes above it. If the bias is bullish, like say we have this drawn liquidity, that's my drawn liquidity right here. That's likely going to get swept today. If not today, it'll happen during news tomorrow. So this is what happens when a bearish FVG gets disrespected. So that's what he was saying. He was like, pay attention to 3814 because if it was to close below this red line, then it was likely to sweep this liquidity before going higher.
And it's because it's highly manipulated. So if it's highly manipulated, I don't want to be in that. Okay, and you shouldn't want to either. Now, if you're forced by compulsion or lack of discipline, you just have to be in here studying on non-farm payroll because you feel drawn to it like a moth to a flame, demo it. Okay, don't trade it live, and then you'll see quickly why you shouldn't do it. Okay, but this purple level here, look what's happening. The market drops back down. I gave it the likelihood of maybe it ran up in here to get above the opening price, and then does it break below this area here, and then tag the 3814 level. Now, if they would have went below 3814, came up into a fair value gap, I would have looked for a run to 3804. And you can find that 3804 level on your daily chart. It's an old daily low. There's your homework assignment for that. But it doesn't matter because I already gave that out. I already gave it out in the previous discussion about why the levels were being done. And I think that would be seen, or heard rather, on my Twitter space that's on Friday morning. Sell sign inefficiency. It's been refined to a tweet where it said, and you'll see
execution.
You're trying to buy at the opening price or below on the daily candle when you're...
Okay, do we have any VIPs in here? Everybody that has questions, write them in the chat, by the way. I'm going to go over them whenever I can. So write them here if you have any questions. We'll stop for a little bit and go over those. So the people that I was teaching me and Christian made a homework on midnight open. That's what he's talking about here. I already know what he's saying when he marked this outline. Is that we're looking for a buy below the midnight, which means this wick down here, anywhere below the midnight price. So that's 12 o'clock a.m. Yeah, 12 o'clock in the morning, basically. When market opens, the new day opens at 12 o'clock. So basically, anywhere below that, if you're bullish, is a high probability entry. So say the new day opens right here, 12 o'clock, and it runs below it, you'd be looking for the buy from the fair value gap or from the lows. Let's see what happened yesterday at midnight. So we have, where is this? Okay. Midnight was right here. Boom. 12 a.m. You guys see that? That's midnight open for Tuesday. So this is now Tuesday's range. So anywhere below it, if you're bullish, is a high probability buy. So let's go on a higher time frame and see what we have on here. Okay, we have a volume void, the concept that he was just using. Now let's go on a lower time frame. Tuesday opens. I'm a little bit lost right now, but okay, starting from midnight price, we run below. We actually disrespect a fair value gap. So this wasn't too precise. This is like the first 2 days of the week, which we don't have any red folder news for. So I don't expect the most precision from here. That's why I didn't get an entry from the bottom either, because it actually didn't respect the fair value gap, and I was like, okay, is it maybe going to go lower? See how it closed below the fair value gap, and normally we'd expect that IFVG from this. So I didn't actually take a trade from down here. But once I saw the move up and it's now correcting the price action that it was disrespecting, then I took a trade and we ran higher from there. So my trade did align with this inefficiency and this IFVG up here. Like I said, disrespected bearish means a bullish move. So it closed above it, tapped back into it, and ran higher, targeting these highs. So anywhere below midnight, so that's exactly what I did. Midnight price, we just bought from below where it opened and targeted the liquidity. And when you're bearish, anywhere above midnight open will also be a high probability sell. So this is a level that you should reference, especially on higher probability days. So we'll have Wednesday's range. Pay attention today what happens from 12 o'clock right here. Somebody asked me if maybe we'll run on Monday's low. We have red folder news tomorrow. We might still run on Monday's low before going higher. That would allow it to tap back into this daily range, this daily inefficiency that we're watching. Like, we still have this entire range to work with. It can easily take out Monday's low and before going higher. So we just have to pay attention to the red folder news. Do we always trade IFVGs after liquidity swept on 1 hour time frame? Oh, that's actually a good point. So do we trade it with liquidity? So that's something that I should have said. IFVGs are the strongest after it takes liquidity. So this one, for example, let's say we are bearish. You obviously want a liquidity sweep to support your IFVG. So here we have a liquidity sweep. Now we're running on sell side. What do? We run below this fair value gap and close below it. This isn't just some random fair value gap. This is after a liquidity sweep. You already have some sort of bias, some sort of narrative. So once we run below this one and close, then we can reference it because it's more higher probability. This one, we didn't get any sweeps of liquidity. It was just kind of like a run, just maybe because of fundamentals, some news. But when you have liquidity sweeps before your IFVG, it's higher probability. So you don't always trade it, but you trade it when you have that narrative, when you have the target. Candle closing below a FVG at 2 a.m. But then it went up. Yeah, that's what I just went over, right? So it closed below this one, 2 a.m. Yeah, that's what you're talking about. So that was just fundamentals, like news. Like we might have had some news that, there was news that Joe Biden was dead, though it's not confirmed yet. But that could have been a driving factor yesterday. It just started randomly spiking. We also had the war news over the weekend, which didn't actually do anything to the price. When we opened up, we ran a little bit, but then we just got this huge sell side. I was like, okay, what's going on? This month is still supposed to be extremely bullish. So I was a little bit sus. I was like, what's going on? It shouldn't be this bearish. But we are consolidating within this daily range, so I'm not really too worried. Yeah, you're right though. This, when it closed below, if we were bearish, this would have been used to go lower. But we weren't bearish. We are bullish long term. That's why we will be expecting buy side. In cases like this, I would just recommend not looking for a sell. Because we're bullish, just let price do its thing. Even if it ran to the sell side, I wouldn't be selling. I'd wait for it to sweep, disrespect a bearish fair value gap, and then I'd be buying. Because our bias is bullish. We want to target higher price. It's been going up for the last who knows how long. It's been going up. There's more buy side than sell side. So we don't want to be rushing sell side narrative just because of 3 bearish days or 4. That's not enough. We've had 20 previous bullish days. Respects it, then I trade off of. What if it trades into an FVG? Yeah, that's the same thing. FVG and liquidity is the same thing. So instead of sweeping the low, we are extremely bearish, and instead of sweeping the low, it runs to a fair value gap and runs higher. That's kind of the same thing as sweeping liquidity. If it sweeps a fair value gap, like fills it completely, runs higher. Let's see if we got any lower time frame fair value gaps here. So it runs into here. Oh, that's pretty tight. So I don't know if I would have used that. But we have this bearish one right here. It closes above it. Next candle taps into it and runs higher. So you can see that it kind of works like that as well. But you usually would want to find a higher time frame fair value gap and one in the discount. So we wouldn't look at this one, but we'd rather look at this one. Okay, let's hop back in before we get distracted.
Bullish.
One last thing. What he's showing on the chart right now, you'll notice the purple level. That's actually, he's showing the midnight price. So just like we were showing before, but now we have a visual of price coming down below it and then trading into that fair value gap and then actually expanding higher as our power of 3.
Yeah, and by the way, this moment in price action that he's like referencing is a New York session. So he's basically referencing midnight price from all the way before London session. That's the power of that midnight price, because you basically have the entire daily range still to work with. The daily range doesn't close until after like PM New York session. So even in New York session, you can still reference midnight price.
And if you get above the opening price, like you see it doing here and here, as it goes back close to that opening price, you can be a buyer there too, if there's logic behind it. And the logic I used was these 2 down closed candles is a bullish order block. It's also a swing high. We went through it here. So this is what I teach you to look for what? The shift in market structure, meaning the market has tipped its hand to you that it wants to go higher. So if it's going to go higher, where's it going to go to? Well, you have an imbalance right here, right? That's fine. You have a bearish breaker here. That's fine too. But look closely. Actually, take a step away from your computer screen, back up in your room right now. Look at this chart a little bit further away, about 10, 12 feet away. You're going to see these levels here are way too smooth. It looks too perfect. It looks too much like classic support and resistance. And here's a note that you want to have in your study journal. And anytime you see levels in your chart that are like this, or they're just too perfect and smooth, I always say this, okay, but smooth edges like to be made jagged. That means when it's smooth like this, the market will rip into that and make it jagged. It doesn't like to have smooth highs and smooth lows. It will always find a way to go back into those levels. It may not happen right away, may not happen the same trading day, but it will always look to go into those levels again. That's what the algorithm does. So let's go back to our analogy. Let's assume that this level here is this level right there on the daily chart. So that level, for whatever reason, we think there's something up here that is going to be a draw on price. Okay, liquidity up here is making the highest probability that the market will want to gravitate to that level. And that just happens to be on our daily chart. That's the level you would have. Well, while you're watching price, when it's down here like this, meandering around like it was doing here, I'm not paying attention to all of this. This is all based on the reaction to 8:30 in the morning at non-farm payroll. So I'm not worried about this price action. The 2 wrong price action levels. If you look at this low here, you're looking at this price right there. If you look at this candle's low,
so he's just showing you guys another fair value gap that formed after it ran from this fair value gap. Ran from it, created another lower time frame. He's on the 1 minute chart right now. So ran from it, created another one.
It's 38 0.25, third level over a 1 minute chart. Okay? So there's a shift in market structure there. So I'm looking at all of this area here below the opening price.
Yeah, so fair value gaps, what he just said, there's a shift in market structure there. Fair value gaps are also showing you that there's strong intentions for it to go higher. So if there's a move that doesn't give you a fair value gap, like right here. Look, do you guys see this bullish move right here? No fair value gaps formed. In fact, this whole price range, it doesn't create a single fair value gap because of the wicks. You guys see that? But here, what do we have? Huge sell side, and we create a fair value gap. That could already be like a confirmation that market's trying to push lower. And it did reference that fair value gap and ran lower. Another thing I didn't draw your attention to over here is that we have a breaker block. We have a high, lower low, higher high. So that's the like essential pattern to a breaker. This is the concept that a lot of like support and resistance traders say, that ICT is the fancy version of SNR. It's the complicated version of support and resistance. But this is like one of 20 concepts. Like support and resistance has nothing like fair value gaps. Fair value gaps are insanely precise. This is kind of like support resistance, to be honest. We look at the highest bullish candle, we draw that out to the right, and we would trade that after it created a range like this, where it sweeps liquidity, runs up above it, comes back into it. That is a breaker block. But the difference between like ICT traders and support and resistance traders is that we actually wait for a close of the candles inside of the midpoint or after wicking below it and pulling back into it. So we're a little more precise when it comes to these breaker blocks. Another thing that he was showing you guys is the bearish candles right here. Let me take a screenshot of that to zoom in. Oh, that's kind of annoying. But anyways, we have these two bearish candles. And he's referencing this as a order block. He's saying that once price traded above it, he used that plus midnight price, the purple line, if you guys can see that on this picture, as his bias to entry. So he has multiple confirmations. So this one, let's say we use the breaker block as our first step. So it trades up from the breaker block. The next thing we'd look for is a change in like structure, which we have here, order block. You pull that order block to the right, and you can take your buy from this, because now you have that shift in the like movement. It was running down first, stopped at the breaker block, created a order block, ran higher, respecting and creating that order block, like confirming that it's an order block. Then it comes back into it and you take your buy. Let's see how much times it references this order block. Boom, even now it's still staying within the range of this order block. So that's exactly what he's doing here. He said, okay, we've created these down close candles. We ran up above them. So now that we're coming into them, this next candle came into it, plus the purple line, midnight opening price. He's referencing this range as his confirmation to push higher for these highs. So you just want to see, like, does the entry have to be on the same time frame as the FVG? I always enter on a lower time frame, but I am mindful of the time frame that it's on. So if we take an entry from the 1 hour for value gap, you still want to pay attention to where the 1 hour closes. So yeah, you can take an entry from the lower time frame, let's say down here when it tapped into the breaker block. But you still want to pay attention to where the 1 hour candle closes, because it takes an hour for the candle to close. So it can wick down here but still have 10 minutes left to close. So it can wick down here, you're like, oh, it's disrespecting this for value gap. So you end up taking a sell, but it still has 10 minutes. And what if it pulls back all the way up, respecting it? Then it could still go higher. So that's why it's important to pay attention to the time frame that it's on, because it could still, like, it still has time to close.
And now this level is this. Conceptually, in my mind, In my mind, this is what I'm seeing the algorithm refer to. I don't care about this. I don't care about every candle prior to that. See, when you're looking at price action, you're getting caught up in all of this noise. My focus, my absolute focus, is only here. Right there. Inside that box. That's what I'm focusing on. That's the initial framework that the algorithm is going to work within. Why? Because that's the dealing range. This is where we are. This is where we made the high for the day. We've left liquidity in play.
Okay, pay attention right here without him talking. I'm just going to drag my mouse. So this is what he's seeing right now when it's down here, right? It's below the midnight price. There's a wick. Now it's up here, and it's looking like this. As price moves higher, so will the daily range. The daily candle will move higher. So being able to see the daily candle like this on a lower time frame is key to understanding where the daily candle will end up closing. So look, down here, right? You don't see much yet. But then it starts expanding and you're like, okay, there's these highs. This is likely where the daily candle will close for the day. So that's kind of what he's talking about here.
Rectangle I drew on the daily chart time frame. It goes right up into it. Look at the body of the candle respecting the top end of that. Then it drops back down into the low end of it, bounces around, hangs in there, and then leaves it. See that? And here is 3 o'clock. Right there. So if your target happened to be this daily volume imbalance, so in your mind's eye, and tracking what the daily range would look like on a daily chart, I mean, you would obviously have a daily chart referred to throughout the day. That gives you the confidence to stay with the trade, because I get a lot of questions all the time. How do I stay in these trades? How do I not get shaken out of them? Because I'm thinking like this, because this is my concept of Power 3.
Yeah, exactly. A lot of people are like, how do you have this like average hold time of 26 hours? How do you even hold on to a trade that long? Because it's the same thing as ICT. I end up taking my trade from Asia session, and I'm paying attention to the entire daily range and the weekly range. So I'm not only paying attention to what today's range is going to do, like here, I'm paying attention to what the next 3 days is going to do. So look here. Remember the highs that I was referencing right here? Look at that. It missed the high, right? Not only did it miss it, but it also missed this huge sell side inefficiency on the daily. Or buy side inefficiency. Sell side imbalance, buy side inefficiency. That's the word that he likes to use, but just call it a bearish FEG. You don't need to overcomplicate things with vocabulary. Look, it missed it. So what I'm thinking already is if I was in a trade, I'd hold it from here probably all the way until like it filled it completely, because I'm bullish overall. So I'm not going to get shaken out from a bearish FEG. I'm going to want to see it filled completely, maybe even disrespected. That's how I'm able to hold for like 2 days, because I'd wait from here. I'd want to see this daily range expand higher. The next daily range open, expand higher. The next daily range open and expand higher. So I already know that the next 3 days are likely to be bullish days. It might run into here, and then we might get some sell side action. This is a premium bearish FEG because it's in the highest point bearish FEG. So let's say my drawn liquidity is here. If you're stuck on your 30-minute chart only thinking about these highs right here, these equal highs, you're going to miss the point of the higher time frame. You might get out after it sweeps these highs right here. And that's a solid trade for you. Sure. But you're missing the whole range that it can actually trade to. Instead of targeting 30 pips from here, you trade one little New York session, you're like, oh, nice. You can lower your risk, expand your stop loss, and hold it for longer periods of time. This way you stay off the charts more, you lose less trades because you're not getting wicked out every 30 seconds. And you're able to predict where the market goes higher. And you're going to be actively learning. Look, watch. Mark these out on your gold charts and watch how these next 3 daily ranges form. There's always like 2 sides like this. You marked out the target where the daily candle was going to close. So the target is this bearish fair value gap for me. So where I think that this daily candle is going to close right now, we still have 3 hours, right? It's 11 a.m. in my time, which is PST. We still have 3 hours until this daily candle closes. It's likely going to close somewhere around here. And then the next one will actually expand into it. So during Asia session today, watch, I'll send out some trades. I'll just show you guys how we're going to trade the PL3. So on the 1 hour time frame, when that new daily range opens, this is how the daily candle looks right now. It's this, like this. We'll see how during Asia session, the next one opens and then runs up into here. So pay attention to that. That's going to be your focus and your objective, to learn what the power of 3 is. Basically from the open, close. Yeah, basically those. Open, high, low, close. You just learn those. Okay, nice. Now he's kind of diving into all the stuff that he sees on the charts. Here he marks out a few fair value gaps. Here he even references a wick. Wicks can be used as fair value gaps too. I just did that recently. Where do we have a wick? It was a lower time frame trade. I think it was down here. I wanted to see a disrespected wick somewhere here. I'm not sure where that was, honestly. But wicks are the same as fair value gaps. They have the bottom, top, and the midpoint. So you can use them the same way, right here. So if this expanded through it and came back into it, you could also pay attention to this wick. You can pay attention to wicks on highs, like big wicks especially. If they're not that big, then they're not significant either. You can just expect it to get swept. But huge wicks can be referenced like fair value gaps. So you should watch some examples of ICT, like using wicks in his price action. Here he has a breaker, push from the breaker, created a fair value gap. Next thing, order block here. He uses the order block plus this wick range to push up higher. It created another fair value gap. It stayed within this fair value gap a few times. Look, first time, second time, came back into it, third time. This third time, it actually ran, created another fair value gap. He says, want to see it stay unfilled. That's most likely because there was also this bearish one before. So now you have this balanced price range. Balanced price range, you guys can write this down. It's abbreviated as BPR a lot of the time. BPR. You'll see it on Instagram a few times. You just want to make sure that they get it correct. BPR, balanced price range, equals a IFEG plus FEG. So it's like a filled range. It's balanced. It has both a fair value gap and a inversion fair value gap. And you don't want to see that kind of range like traded to. So right here. Typically we wouldn't want to see it. This is the IFEG over here on the left side, a bearish fair value gap, and this is the bullish one. So if you're targeting these highs, you probably wouldn't want to see it come into this because it's balanced already. Eventually at some point in the future, it's going to run like lower and disrespect it. But I'm talking about in the moment when you're trying to buy into your liquidity here. This is a range that was created that's likely not going to be referenced. Like that's why it didn't pull back here. Instead, it ran from this breaker block towards the liquidity. So there's concepts that even like you don't want to see get filled. You don't want to see it reference at all. You just want to see it stay unfilled. Here we have another fair value gap after. So up the high, tapped into it, ran higher. Another fair value gap. Tapped into it, ran higher. It's just showing you Like until it hits its range, it's going to be extremely bullish. Finally, this high right here is the daily inefficiency that he marked out. Finally, it traded to it. Now we might get some sell side. But until then, most fair value gaps will be respected like this. So if you have highs here, it's going to be respected. Next fair value gap will be respected until it takes out its high. Then once it takes out that high, you can start seeing bullish fair value gaps start getting disrespected. Christian, do you have anything to add? I'm going to take a break real quick. I'm going to mute myself.
Sorry, I'm trying to fix my mic. Just again, like following our higher time frame draw. So he had mentioned there's like fair value gaps, there's breakers against us, and that doesn't matter. We're not even considering that because what's going to make our bullish PD arrays work is actually the draw. So first it was the stacked highs, which was the buy side liquidity. Right here it says 3876. And basically, with a lot of these market maker buy models, we're going to see multiple opportunities to enter. So we have at least 1, 2, 3, 4, 5 chances to enter. And not only that, we could pyramid into our entry. We're moving our stop as we go up. So if you're able to master the market maker buy model, then you'll be able to basically scale into trades. You're going to be more confident, and you're not going to be scared of missing trades because you know there's going to be multiple legs within that single entry. And yeah, so pretty much how you're going to be catching these larger moves is you're focused on the daily candle. Like Mark was talking about, we're going to trade below it, and then we're going to find some kind of displacement that's showing a willingness. It's going to go higher or lower, wherever we expect it to go. And that's how you're going to catch these larger moves, is the actual daily candle and anticipating that. Whereas I see so many people trying to catch these like smaller trades, and if you can master it, yeah, you could scalp. But if you want to lessen the amount of trades, then just focus on the power of 3 candle and catching that full expansion.
All right, thanks for adding that on. Yeah, we should do some calls during Asia session. I'm probably going to plan that for the future because while we're doing the call, we can also watch and observe the price action. And I can tell you guys how I'm expecting the daily candle of that day to expand from Asia session. So that could be a good learning experience. Because if we do them like towards the end of New York session, you're not going to be able to learn as much. But maybe on like days later in this week, we'll see some more precise price action because of the red folder news. So let's just let time decide. We'll definitely learn how to use these PO3 candles and just observing the daily action, the daily like range on the lower time frames. That's your objective. And that's going to be all for this call. There's probably just a bunch of yapping about how he was right in his tweets. I mean, it feels really good to get it right. You're going to be able to do the same thing soon, where you literally like see it close perfectly and you're like, okay, pay attention to 2412. That's what you tell your friend. And it goes exactly there. Boom. You're going to be like a wizard of the markets. Magical predictions. That's how it feels once you get this down, because you can literally predict what it's going to do to the dot. Just like how in the weekly analysis I said, wait for the sweep, pull back into the midpoint, and then we buy from it. Look what happened. Swept this low, pulled back into the midpoint, and ran from it. Like I said that on the week before the market even opened. How did I know that? Because it's basically what I've been seeing for the last 2 years. This precision. You can see it before it even happens. That's why I want you guys to learn this stuff. I don't want you guys to join our group and take signals from us. You want to be able to catch this stuff on your own and adapt to it. Especially if you want to make this like your full-time job. If you want to trade for a living, Learn how to do it yourself and stop relying on other people. Thanks for joining us today.